Welcome to TheoTrade. This is Don Kaufman. You are watching the weekend update for March 10th, 2018. All right, let's get started with the very notion that this marketplace is far from what you think it is. Now I'm going to qualify and kind of quantify that statement as we go along here, both in this video and again as we get into the charts here in a moment. Again, think about that statement. It's a fairly bold one. This marketplace is absolutely not what you think it is. All right, let's go back to some of the trade this past week. We see a ripping rally, but let's put it in perspective. So what? We saw a rip and rally. We've also seen some fairly wild sell-side activity. This is not a time to be high-fiving one another because we saw, a 44-point move up in the S&Ps following non-farm payrolls. Speaking of non-farm payrolls, they were stellar. 313,000 in the non-farm payrolls. Now, I'm not telling you anything you don't know, but the one thing I think that surprised me as a trader is that this was accepted as something, this is all of a sudden positive, right? How is that positive? Because this is going to cause the Federal Reserve, of course, Jerome Powell, and we're not exactly sure what to expect out of him yet, but it's going to cause the Fed to hit the accelerator when it comes to, hey, are there going to be 3 rate increases this year? Are there going to be 4 rate increases this year? And the answer is yes. They're going to hit the accelerator when it comes to rate increases. And to see this kind of knee-jerk reaction in the market exploding higher, surprising to a lot of traders. But I don't want to digress too much down the path or blaze a path that already happened. That is, we saw a rally. Great. You also have to remember that just 2 weeks ago, if you look back in a chart, and we will here momentarily, you look back at a chart February 26th, February 27th, guess where we are? The exact same place we are right now. All right, what did we see happen after the 27th? Well, February 27th, we saw some pretty strong sell-side activity. So what? We bounced back to it this week. And again, everybody's high-fiving, the Nasdaq's at all-time highs. But again, I'm going to go back to that original statement. This market is not what you think it is. Now, why do I mention that? All right, here's where I'm going to kind of geek out on you for a moment. On a week-to-week basis, we have tendency to look much more as quantitative traders, and I would definitely categorize myself as a quantitative trader. We have tendency to look much more, at, not so much charts, but really what the market is doing structurally. And one of the things that we look at extensively is on a week-to-week basis, we look at what's termed expected move. And we look at expected move specific to the SPX. Why the SPX? People, it's the mother of all products out there. You get this $2,700 behemoth, and the amount of order flow in the SPX, in the options in the SPX, really dictates a huge amount of the trade that occurs inside of the S&P futures. Now again, what I'm going to talk about right now, I don't want to geek out too hard on you here because not everybody that tunes into this is an options geek. But even if you've never traded an option, you really have to respect right now, right here, what the SPX is telling us on a week-to-week basis. I'll give you a quick example. When I say a week-to-week basis, today happens to be a Saturday. It's March 10th. Now, just shy of a week from now, coming into Friday, there's going to be an options expiration. That expiration is dictating right now, it's termed the expected move, about a $40 move. Now, it doesn't tell you which direction. The options themselves don't have any directional bias to them. They're saying it's about a $40 move, either higher or effectively lower. Now, where does that $40 come from? Is it just, pulled out of thin air? Of course not. The $40 expected move is based quite definitively on the option pricing itself. So they take the option pricing. Now, why does the option pricing matter? I don't know. There's billions of dollars, being traded on either side of that bid or offer. The options pricing in the SPX, again, it's billions of dollars. It's skin in the game. This is not some, 618 Fibonacci over here. You're resting and relying upon billions and billions of dollars. Now, why do I mention this expected move on a week-to-week basis? This is why. And this is why I also quantify the statement, this market's not what you think it is. And it's simply because the expected moves thus far since the beginning of the year are getting hammered, smoked. I have looked back, at data corresponding to the beginning of weekly options. And we have never seen the SPX act like this since the inception of weekly options. That is, what we're seeing right now is the expected move is just off. You know what that means? That means billions of dollars, okay, are being capitulated. It means the options market is doing a completely inefficient job at even pricing forward risk. And this is where you get a lot of retail clients, they're all high-fiving one another. Yeah, we're rallying back over here. And you're missing the bigger picture. And the bigger picture right now is the options market is doing a terrible job at quantifying risk. What does that mean for you? It means even the professionals right now are dead wrong. And you need to recognize that, because all risk, is just totally up for grabs here. And before you start high-fiving everybody based on a 44-point rally, this is not about being bullish or bearish. I want you to realize that when I talk a lot about get your risk in check, people, that could be if you're long or you're short. All right? The markets right now are simply screaming, chaos is upon us. If you don't see it, I'm about to show it to you. Let's get to the charts on this weekend's update. All right, let's get to the charts. First, we are going to start with none other than the SPX. So I want to quantify and again qualify that statement that this market really is far from what you're seeing and what you think it is. So let's bring everybody up to speed. If you've never looked at the expected moves, and the expected moves that I've got here, these are ones that I actually drew by hand on a week-to-week basis. And we have an auto expected move formula, but I still prefer to draw them by hand, okay, for deadly accuracy on a week-to-week basis regarding the SPX. Now, again, let me explain a little bit about them. There's 3 lines drawn each week. The central line is the starting place for the week. So, for example, if the SPX was at, 2680, that would effectively be, the starting point for the week. Then, of course, there's an upper expected move and a lower expected move. Now, last week, and that was the week that we just finished, literally yesterday, last week, the expected move was plus or minus $44. Now, again, there's no directional bias to the expected move. See, if you think of expected move, think of it as being a distribution curve. It's just saying plus or minus, and again, $44. That means we can go $44 higher or $44 lower, right? All right, so that $44 happens to be based, now I'm going to come over here to the trade tab for a moment, that's based on the options, okay, that are exactly a week out. That is, on a week-to-week basis, I look at options that expire on a Friday, and to even be more specific here, it's a Friday afternoon. I use the weeklies, and you can see that this coming week, now we're not looking at the past, we're looking not only in the present, we're looking into the future. I mean, that's what the options market does, and that's why we pay so much attention to the options market, is the options market is putting a price tag on risk to the future. So this next week, it says that the options market is supposed to move $40. Okay, and I drew that on the chart already. So let's go back over to the chart for a second, and you can see if we zoom in, what does that amount to? Well, here we are. We finished the week right at 27.87. Well, we can get up here all the way in the neighborhood of about 28.27, or down to about 27.46. Now, time out for just a second. And we've been tracking these expected moves for years and years. And you can see, if you go back in time, you can see, all right, there's a little breach of an expected move. Couple of weeks go by, more than a month. Oh, another breach of the expected move. But the key is these expected moves, like if it says it's supposed to move, and I'll give you just an example, plus or minus like $40, okay? It's does the marketplace close outside of the expected move by the end of the week? It's what we call a probability of expiring. And here's a week where, yeah, we broke outside the expected move. But again, it's fairly nominal and it's extraordinarily infrequent. So if you start looking back, again, on most of 2017, by the way, we can go into 2016, we can go into 2015, there is nothing, okay, that we have in any data that shows this many breaches of expected move. Now, of course, you're going to look at this and you're going to think to yourself, oh, great. So who cares? The options market is wrong. Really? This isn't about the options market. Okay? This isn't just about the options market. Allow me to take you into a wild, and you're not going to look at the market quite the same after this, but a wild display of why this expected move matters so much right now and has mattered for years. Look at the SPX, okay? First of all, this thing is a $2,786 mother of all products, and it traded, again, let's just throw the number out there for your consumption, 2.2 million contracts traded in the SPX. You're like, whatever. Okay, well, you know what? Yesterday, being Friday, the entire marketplace traded 23 million option contracts, of which, this is kind of ironic, about 10% was the SPX. You go, who cares? Whatever, Don, it's 10%. Yeah, but the SPX is also at least 10, maybe even 20 times the size of like Apple. You know, think about like, oh, Apple. Oh, okay. Apple is still what? You know, $180 product? Who cares about Apple, right? It's a $180 product. Doesn't matter how many option contracts it trades. Let's go look at Apple because I want to make, again, this needs to be so apparent. Apple traded maybe 500,000 contracts, right? But again, it's a $180 product. Nobody cares about a $180 product because when you're trading a $2,780 product, oh boy. All right, that's a lot of notional value against it. But wait, there's more. Let's go to the spiders. If you cruise over to the spiders did 5 million contracts. The spiders, okay, are basically the same thing as the SPX. So now we have the spider volume, which is 5 million, plus another we'll call it 2 million. So now we're already cruising close to what? 7 million plus. But wait, there's yet another product that's directly influenced over here. I would be digressing if I didn't mention the VIX too much, but the VIX did another 1.4. So when you start looking at it, okay, just on the surface, and you start recognizing the SPX is running the show. And why is the SPX running the show? How many, and think about this, S&P futures contracts are needed to hedge, okay, basically 8 to 9 million contracts that are trading all revolving around the SPX. Okay, the answer is most of the S&P contracts that are trading are hedges against the SPX options. And this is the part where most retail clientele, they never get to this level in trading. You know, again, I started in this side of the business in kind of on the risk management side of the business, and we used to buy and sell S&P futures to hedge our SPX positions. And you just have to recognize when you see volume like this in the SPX, okay, that's monumental. And a week out from now, and again, how does this all relate? A week out from now, the $40 expected move, that is not what like an equation says the market's supposed to move. That is bids and offers. That is tens of billions of dollars. That's the point that people just, they don't get. This is tens of billions of dollars. And look, there's a PM expiration on Friday, but there's also an AM expiration on Friday. Look how much. It's just the volume. The open interest in here is nothing less, okay, than phenomenal and staggering. And yet, when I say this market's not what you think it is, okay, look what's going on this year. This is a breach of expected move, a breach of an expected move. Here, okay, this next week, look, there's no breach of expected move. The very next week, breach of expected move. The very next week, breach of expected move. Here's another breach. Here's another breach. Wait, the very next week, nothing, okay? The week after that, huge breach, monstrous breach again. Do you realize, okay, what you're seeing right now? And that's where people go, no, I don't really get it, okay? The marketplace can't even figure out what the heck the risk is. It's total chaos. Okay, this is pandemonium in the SPX options. This relates, though, to the entire marketplace. No one can categorize the risk. The options market is totally off. And that's where, first of all, there's huge opportunity in here. But this is the argument that I was making. I don't care whether you're bullish or bearish. I don't really care at this point. Listen, I have a long duration bearish stance in the marketplace. I do. That's my opinion because it's a rising interest rate environment. Hey, that's fine. But I don't care whether you're long or short. Right now, you take small, defined risk stabs at this marketplace. Doing any more, you're going to get your head taken off. Okay? This marketplace is out, okay, for the kill, whether you're long or you're short. Now, I'm going to take off the expected moves and everything for just a second. I also made a quick statement over here as everybody was like high-fiving themselves like, look at the rally this past week. Yeah, I also said we're right back to where we were when? February 26th, February 27th. We're right back to where we were. So 3 days damage was done. Okay, it took us 1, 2, 3, 4, 5, 6 days to get back over there. So seeing a rally over here, it's no surprise. I also mentioned this in the last couple of weeks. It wouldn't surprise me to hit all-time, new highs in the S&P. Granted, the Nasdaq is already effectively there. Speaking of the Nasdaq, all the risk in the Nasdaq is really being concentrated now into, okay, Netflix is becoming a larger and larger player in terms of concentration of risk. What does that effectively mean? You have a handful of products that are driving the Nasdaq, okay? And those handful of products, the market cap is so large. Obviously, Amazon is really the biggest of them. And by the way, with Amazon, you got to look at this on a year-to-date percentage. It's up 32%. Of course, that's nothing if you take a look at Netflix, which is up 65% year-to-date. But Netflix market cap still is minute compared to Amazon. So what you're getting is a concentration, okay, of liquidity into one heavy market cap that can actually push the Nasdaq around. It's not dissimilar to what we're seeing in something like Boeing that's pushing the Dow around. People, everywhere you look, and again, I intend on this video to scare you because looking at stuff like these expected moves, right, is totally chaotic. Again, you can look back into all the history you want in terms of expected moves. In fact, I even have an auto expected move, all right, calculator, and I can go back and I can study years of data. Here's 3 years of data. You will see nothing like the breaches that we've recently seen. And subsequently, you can look back, the breaches that we're even seeing right now, okay, are far larger than anybody has seen in the markets. Okay, again, the option market is telling you we are doing a horrific job of pricing. One last thought I'm going to give you on the SPX before I move on here for just a moment. But the last thought I'll give you on the SPX, okay, this previous week, we had about a $44 expected move. This coming week, we have right around a $40 expected move. Again, that's higher or lower. Why I find that interesting, it's because this week we rallied huge. And in a huge rally, you would expect the volatility to contract. Yeah, volatility did contract, but it didn't so much contract in the short duration. The volatility contracted, all right, in the longer duration, which frankly, nobody really cares about right now. Everything is right here, right now. It's instant coffee, instant tea. So it's another interesting thing to look at is we're flying to the upside this past week without volatility in the short duration really contracting very much. Again, we'll keep our eyes on the SPX throughout the course of the week. As I said, a 44-point move up in the S&P futures, $47 in the SPX, which is roughly, okay, I mean, that's outside the expected move of the entire week, all being done effectively in one day. All right, so moving forward into this week, I would not be surprised to see even a little bit of follow through come Monday, Tuesday, all right, to some of the rally that we've seen. Obviously, one of the things that we're going to be watching very carefully, okay, is any movement to any degree in the bond market. So the bond market right now has flattened out. And if the bond market does continue to see some sell side activity, here's where my own opinion and directional bias are going to come into play. Any sell side activity, once again, in the bond market it should make you nervous as a long duration investor. Why should it make you nervous? Sell-side activity in the bonds is going to raise interest rates, whether you like it or not. Nobody wants to face that fact. As interest rates come up, this is going to affect everything from mortgages, but credit card debt, student loan debt, okay? Forget about it. U.S. Treasury debt. I can go on for a half an hour. Junk debt. Companies like, Tesla live off of their debt, and servicing those debts is going to go through the roof. But everything from the, consumer all the way to the, trying to pay off the U.S. Treasury, those are going to go skyrocketing if these bonds continue to sell off, and it's going to be a massive headwind. Okay, by no means, just because the volatility backed off a little bit in the VIX, by no means do I think that we are out of a much more volatile situation. As I said, it's chaos a brewing in the SPX when the options market, they just can't get it right. Thanks everybody for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.